other funds and other options. And I'm a lawyer, so you know I got to give you the disclaimer. This presentation is for informational purposes only and should not be construed as legal, tax, investment, or estate planning advice. Okay, so this is actually excerpt from a program that I'm running called Leap Up. It's about not just giving yourself a step up, but really leaping forward with your business. I actually have something called 25 ways to fund your business without investors. So time permitting, I'm going to give you as many of the 25 ways as we can fit in, time allotted, for free. But this is something that people normally pay for. So, you know, pay attention.
So you're freezing up on me.
Succeed. Gathering. She knows she would be successful, and it would this idea keeps rolling around in her head, and she feels really stuck. She wants to leave her job, but she's afraid to do so. A year passes without Mary starting, and then another year and another year. And then she finally came to me because she's like, I'm really considering giving up on this idea because I just don't know how to get started. And when we started talking together, we realized that she had some options. You know, one of the ways you realize you can have option is go and visit your SBDC counselor, because that's at no cost to you. And they're seasoned business owners. A lot of them are seasoned business owners themselves, so they can give you some options. I also pointed out that the retreat center for writers would be cool, but she doesn't have a shoestring budget and work with individually or in small groups without even having the retreat center. And then that's how she would get started. So the first thing we did is we would determine how much funding you need by calculating. I said, okay, if we just did working in small groups, what are your real costs? And if you don't know how to do that, again, go to your SBDC counselor. They can help figure out what are your starting costs. So for Mary, we looked at the cost, which was very writers retreat group on Zoom in a small group. Really, it was her time, it was advertising, and it was, you know, if she wanted to do it on Zoom, it would be the cost of a Zoom account. So what you want to do is figure out your costs, determine your break-even point, and then estimate your profits. And again, if you don't know how to do that, go to your SBDC. They can help you with that. So we discovered that Mary could start working with writers in small groups or even one-on-one with very little operating costs. So she really didn't actually need funding to start her business, but she still wanted to do her retreat center. So let's actually talk about funding options for Mary's retreat center, because she has this vision and she's not going to give up on it. And as her individual work with individual writers grows, as her small groups get bigger, she can certainly add on retreats at the retreat center. So today, the main part of this is we're going to look at funding your startup using retirement funds. And by retirement funds, I mean your IRA, your 401k, or your 403b plan. And if you don't know what that is a retirement plan for certain types of employees, like if you're a teacher and you work for a school system, or if you work for a tax-exempt organization, it's a 403b. They function very similar to a 401k. But so let's look at that. Okay. Along with that, we're going to look at different ways you can use retirement funds. So we're going to look at 401k withdrawals, because a lot of people think this is the only way to do it. And I want you to have a baseline understanding of what a withdrawal looks like. We're going to talk about something called ROBs, which is rollovers as business startup money. We're going to talk about 401k loans, and then we're going to talk about COVID distributions. I had this come up with another center, another area. They were talking about this thing called ERPA. That is not actually a law. If you Google that or you're reading that on the internet, that is not a law. That is what a particular company has called their ROBS plan, and they talk about it in a very official way, and so that's the name of their plan. So let's look at the first scenario, a 401k withdrawal. Let's say Mary needs $15,000 and takes a non-hardship withdrawal from her 401k, and that her 401k has $38,000. Because Mary under 59 and a half years old, she's subject to a 10% penalty, and she has to pay her taxes up front. So the result is she has to actually withdraw $23,810 to get $15,000 in cash, because she's got $8,810 in taxes and penalties. So what's left in her 401k is about $14,000. So the pros of this is Mary doesn't have to pay it back because it is a withdrawal, but the con is she has to pay the $10,000 penalty plus taxes up front. Now there's a better way to do it that you don't have to have penalty and taxes, and that's a ROB, and that's just an acronym for rollover as business startups. So how this would work is Mary starts a C Corp, and we're going to call her C Corp Writers Retreat. Writers Retreat creates a new 401k plan that permits investment in qualifying employer securities, which I'm going to call QES, just as an abbreviation. And then Mary becomes the only employee of Writers Retreat, and she's the only participant in the new 401k. So then what happens? She rolls over from her existing IRA or 401k into Writers Retreat's 401k. She then invests her account balance in QES, the qualifying securities, which are purchased from Writers Retreat stock. And then as the owner of the 401k, she causes Writers Retreat to begin the business using the 401k proceeds. So basically she's saying, I'm creating a 401k within my own business, and I get to direct what happens to my 401k. And so I'm going to tell my 401k to invest in this company called Writers Retreat. The pros are you fund your startup without any traditional loans or debt. But the con is it could affect your timeline for retirement. The pro is this is tax and penalty free because you're rolling it over as if you got another job and you rolled over your IRA or your 401k. So there's no tax or penalty to it. The con is it risks IRS audits because the IRS does give it a high level of scrutiny. The pro is you have potentially greater control over your own investment. Con is you could have a potential administrative burden because you can be now designated as a plan administrator or plan trustee. And then when you add other employees, I usually recommend setting up a different plan for your actual employees, which can be done. It's not difficult, but it is more paperwork. The reason why I say there's a risk of IRS audits is because this is actually a cut and paste off the IRS website. The IRS actually did a research study on ROBs, and they called it the ROBs Project, and this was their finding. Preliminary results from the ROBs projects indicate that although there were a few success stories, most ROB businesses either failed or were on the road to failure with high rates of bankruptcy, liens, and corporate dissolutions by the individual secretaries of states. some individuals who started Rob plans lost not only their retirement assets they accumulated over many years, but also their business. Much of the retirement savings invested in their unsuccessful Rob plan was depleted or lost, in many cases, even before they had begun to offer their product or service to the public. And I give that to you because I do want you to be aware that the IRS really doesn't like Robs. So as a result, they think your business is going to fail, and so they will audit you. I think a lot of that has gone away because I think companies have gotten a lot smarter about how to implement this. Money, he just used it as collateral. And so he used that to start his business. And then now his business is doing very well. And so now it's the opposite. Instead of using the Rob to fund his business, he is just maxing it out with matching as much as he can. So now he's really pumping up his retirement benefit when he does actually retire. So I've seen it work successfully to talk to you about. So be cautious about what's going on, like be cautious about setting it up, but also know that you can actually be successful. Now, if you don't want to do the Robs because you're concerned about the risk, there is a third option with your 401k. You can actually take a 401k loan. And how that works is like this. So Mary borrows $15,000 for her 401k that holds $38,000. Depending on your 401k plan, that means Mary could generally take out 50% maximum of $50,000 within a 12-month period and pay it back within 5 years. In a shorter time frame. The pro is the interest goes back into her 401k, so she's not losing a whole fault.
Tisha, can you hear me?
I think we just lost Tisha. So as we're waiting for her to log back in and join us, we can kind of elaborate a little bit more on the topic that she was just mentioning. And Tisha, there we go.
Okay, because this is amazing information.
It is. It's fantastic information. And I've done that part, and many others may have also, as far as taking a loan off of a 401k. And so you just simply pay it back. So you're kind of paying yourself back interest. So that's a really easy way of getting access to your cash that you put away in your savings, to help fund that startup whenever you need that initial equity, if you need more access to cash. Tisha, I'm glad you're able
I've done that too. I've done that too and paid it back in like 2 months. It was fantastic.
Right.
Yeah.
Anyway, it's good to have you back, Tisha.
I am so sorry that I lost you all. Where did I leave you all?
You were talking about the 401k and using it and paying it back. And then your last slide was on if you left your employment, you might have to pay it back earlier or make some of the kind of adjustments that could, put a financial strain on someone. And actually, one of the thoughts I had on that is if someone was doing that where they borrowed off their 401k, that would be assuming that they're staying with their employer, perhaps, too. Many startups maintain their regular business and start some gig on the side and or hire some other support for them. Some people are doing the business themselves. There could be being an entrepreneur takes a lot of grit. And so we have the highest respect for them. And actually, that's one thing I think we love about our job and getting to help entrepreneurs, because we helping them through that struggle.
Right. Well, and then there's also the possibility you can roll it over. So let me show you real quickly the difference between taking a loan or withdrawal. Like, how would that actually affect your 401k in the long term? Can you see that?
Yeah, yes.
Okay.
Good.
Great. Okay.
We love the information you're bringing us.
Oh, good. I'm glad. So let's just say Mary was actually 45 years old and she had 38,000. You can see the gap between taking a loan versus a withdrawal. So I would always encourage people, hey, if you can, take a loan, because you're potentially losing 66,000 by the time you're 67 years old if you do a withdrawal. So I would say, if you can, take a loan. Yeah. Okay. So for COVID, we also have something specific in the law that you could also take a COVID-related withdrawal off your 401k, 403b, or IRA for up to $10,000 if you are diagnosed with COVID, or your spouse or dependent is diagnosed with COVID, or you experience adverse financial consequences as a result of being quarantined, furloughed, or laid off, or having to work reduced hours due to COVID. If you have a problem that you are unable to work due to lack of childcare due to COVID, or you experience adverse financial consequences as a result of closing or reducing your hours in a business that you own or operate. So you can take a COVID-related distribution. The benefit to that is, if you do it under COVID, then there is no 10% penalty. You pay your taxes over a 3-year period. And if you pay it back over the 3 years, you can amend your tax returns and ask for a refund on the taxes you have paid. The other benefit to this is you can divvy up your taxes over the 3 years. So for example, let's say you took out $9,000 as a COVID-related distribution in 2020. You could declare it all in your 2020 taxes and pay taxes on the 9,000, or you could divide it up over 3 years. And so you would say you would pay taxes on 3,000 in year 2020, 3,000 2021, and 3,000 in 2022. So you can also push back the taxes over a 3-year period. I think that's an option for a lot of people. So if it's related to COVID in your business, you can certainly take a withdrawal without incurring penalties. So looking at some more traditional options for Mary, don't forget that you can also look at your personal savings, which I highly recommend. You have personal savings, and then save a little extra to start up your business. If you want to do a small business loan, go to your SBDC counselor, because they can definitely help you with that. You could also consider a home equity loan. The average startup business owner in the United States has 25% of equity in their home. So home equity loans are actually quite popular. And then if you want to do a really short cash flow type of startup money, you could do credit cards. I don't like doing credit cards, but if you just need it for like 30 days, then put it on a credit card and pay it back. Non-business solution is if you have qualified medical expenses, you have an HSA, you could also do that to kind of decrease the monies you have to use your business. Now, one thing I do want to also get into is the idea of a home equity line of credit, because I do have people ask me about this. Everybody seems to understand what a home equity loan is, but they don't seem to have the same level of information with respect to a line of credit. So very quickly, a home equity line of credit means you're borrowing against the equity of your home. Like a credit card, you draw from and repay, usually with variable interest rates. But unlike a credit card, a home equity line of credit typically has a fixed draw period, like 5 years, 10 years, after which it closes and any remaining balance must be paid back with interest, usually before the repayment period ends. So usually you have 10 years to pay it off, up to 20 years to pay it off. Now, here's where people also get confused is the IRS may allow you to deduct the interest off your line of credit if you use it for home improvement. But if you use it for startup funds, you don't get to deduct the interest. I tell my folks, instead of using your home equity line of credit for actual startup funds, it might be better to use it for liquidity, to back up your short-term savings and use other monies to do the startup, but just have it there as a sort of like fallback plan B. Or you might use your home equity line of credit to do debt consolidation, because generally a home equity line of credit is going to have lower interest rates than stuff like credit cards. The caveat I would say is ensure that you have a rock solid payoff strategy, because you are actually putting on your home on the line if you can't pay it back. So make sure you have a rock solid payoff strategy, because you don't want your business to you don't want to start off your business and then also be putting your house at risk. So that's a home equity line of credit. The other thing is what you might not know, but if you have a retirement plan, generally you're investing in stocks, right? You can take a margin loan off your actual stocks. So how that would work is a brokerage firm lends you money against the value of your eligible stocks, bonds, exchange-related funds, and mutual funds in your portfolio. Typically, it's a minimum of $2,000 in cash or marginal securities. And marginal securities, all that really means is the stock that you're investing in is traded on a major exchange. Really simple, easy peasy. And limited to 50% of the investment's value at variable interest rates, which are usually less than credit cards. So traditionally, a margin loan is used for additional investments. That's really the whole purpose of a margin loan, but you can use it for short-term liquidity needs. So like if you wanted to use it for your startup business, you certainly could, or like I was saying earlier, just use it as a backup plan to have in case something happens to your actual startup funds. The benefit is, unlike a home equity line of credit, you don't have this lengthy application to go through. You don't have to get your house appraised. You simply just get the ball rolling. But just be really careful, because it could create a decline in your investment portfolio. And so then you're going to be subject to possible taxes if you have to sell your investments because you haven't paid off your loan. But that is another option for you to use essentially the monies that you have in retirement that are invested. The other choice you have is you could do a security-based line of credit. And this is kind of why I went through the home equity line of credit. So you can kind of get an idea. You can basically get a line of credit to borrow against the value of your portfolio, and it usually has variable interest rates. So the assets are pledged as collateral and held in a separate brokerage account from your regular account that you have, your portfolio of investments that your retirement account is in. And then generally you have to have a minimum line of $100,000 and initial minimum advance of $70,000. So how do people really use a security line of credit? A lot of people use it for bridge financing. The most common way people use bridge financing is for those who they want to buy a house, but they have their old house that they still need to sold, but they want to put the money down for their new house. So they'll use bridge financing. They'll use bridge financing to make it happen, right? It's a short-term way to finance the purchase of a house. That's the most common way security-based lines of credit are used. But you can use it for your business to have liquidity, because it's quick access to cash without selling your investments, and you avoid capital gains taxes. But the risk here is that if your collateral decreases in value, the bank may demand immediate repayment. So you want to make sure you diversify your assets. And then just as a really quick sort of, let's just kind of compare this. I put it together in one chart. So you can see the differences between a home equity line of credit, a margin loan, and then a secured back line of credit. So you can see the differences here. I honestly, if you're just looking for short-term liquidity, all of these are really good choices. I would not use the margin loan for short-term liquidity, obviously, because if your portfolio value declines, then it's going to cause you a large tax bill, possibly maintenance costs. I really wouldn't use the margin loan for that. The security backed line of credit, you could use it for long-term liquidity. I'm just going to also throw this out here is because we actually, when my husband and I bought a house, we actually needed bridge financing. And there was a woman who was already in retirement mode. And that's what she did as her side gig. She would actually lend people bridge financing loans. And she made really good money off of it. And she basically used her stock portfolio to give people a bridge loan, and then she would charge like a little bit higher than normal interest and make money off of that. And for somebody like us, where we were much younger, it was a great idea for us because we didn't have to get into a really big loan. We were willing to do it because it was for 30 days. We were willing to pay that interest. So you could actually create a startup business in retirement where all you do is help people with bridge loans. So I'll just throw that out there. Okay, so before I get into the next section, does anybody have any questions?
What about on that, Rob's, when you were talking about, the extra legal documents on it? Is there a threshold amount that you usually want to borrow before it to be cost effective to incur the legal costs for those documents?
So that really does depend. I would say, I mean, for somebody like Mary, it was worth it for her to consider the Robs because that retreat center was going to be acres and acres. Ooh.
For the legal documents to do that, are we talking $6,000, $10,000? What is the cost to do those types of legal documents to do the Robs?
So really, that's kind of what the market will bear. I've seen it as little as 5,000. I've seen it as much as 15 to 25,000. But it's also dependent on what you're buying with it. So like the lower cost plans, they're basically giving you a lot of form documents, and then they're expecting you to implement on your own, which is why we get to this potentially administrative burden to be a plan administrator or trustee. I think you kind of get what you pay for, and that's why I think the IRS really doesn't like it. But, if you go the higher levels, there'll usually be somebody who actually does the financial planning for you. So they're actually doing that administrative work of managing your investments. So you're paying more for it, but you're also getting more for your dollar, right?
Well, the example that you gave earlier where she needed 15,000, but she really needed 23,000 to get the 15,000 because she's going to have the 8,000, in penalties and taxes and such. I was thinking, well, this is not a very suitable alternative for something like that for a small amount of 15,000 if you're going to incur $10,000 worth of form document and legal fees. You almost need to have, there's got to be a threshold somewhere where it's a little bit higher so that way it keeps in a reasonable percentage.
Right. I think if you have other options, I would consider other options before the Robs. For somebody like Mary, we did 15,000 honestly because I had an example where they had calculated all the taxes, and so I knew it was going to be accurate. I probably wouldn't get a higher priced Rob's plan for something like Mary if she only needed 15,000. But for my client he really didn't need all that much to start his business, but the way it has expanded now, he's in multiple locations with multiple divisions. If he had originally started that way, I would have said, yeah, Rob's was the way to go, even though there was the potential for an IRS audit. So for
Well,
somebody like me,
it has a longer life though, whenever you think about taking the penalty, and I'm kind of comparing the cost of doing these choices, but you pay that penalty and interest cost, that's just a direct expense that you had that you don't really have any other value for. Where the ROBs, you have an expense of setting it up, but it's going to have a longer term value if you're recognizing gains on the investment that your hard work is building that investment and the return on it. I think would
right,
be another way of justifying that cost when you're considering the alternatives. Is that
right.
appropriate?
Yeah, and also, it also depends on if you have a job with a 401k plan. A lot of times companies only give you like 3 choices of what you can invest in. And so if you have your own ROBs, you get to really control where you invest. So if you're more of a risk taker, or like, let's say you're in your 30s and you're a risk taker, then you may take a riskier investment plan than if you would have if you were closer to the, in your 60s, right? It just kind of
I'm
depends on.
wishing I knew that whenever I was younger and in a 401k plan, and I could have had more choices than just the narrow few that maybe an employer offered. I like that point.
Yeah. Well, so as a funny story, right? I worked in a law firm that they let you invest in pretty much anything you wanted. And this was back in the late 80s, early 90s. And one of my colleagues, she's still my friend, we still keep in touch. She invested in this thing called Apple and she forgot about it. And so 15 years later, they're like, we're closing the 401k. Do you want to roll your stuff over? And she looked at it and man, it had like more than doubled because she had forgotten about it. And at that time, nobody really thought Apple would be what it is today. So you never know.
Wow,
You never know.
that's exciting.
Yeah.
All right, let me get you back on topic though. So
Okay.
you had a lot of good stuff still for us, didn't you?
Okay. So less sexy, but what I tell every single client to do, oh my goodness, I should not have gone so far back, is what I call the 5 C's, clever cash to create confidence. And this is stuff that you can do without trying to get a loan or trying to finagle your retirement savings. The first thing I tell my folks is, let's look at the 5 C's, which is not sexy, but will bring you money. It's what I call money on the table. One is, the first C is clean up. And so cleanup means sending out invoices if you have not already done so. I do this as part of a mastermind group of women entrepreneurs. And when we sat down and did this, the lady at my table realized that there were $75,000 worth of invoices that she had not sent out. Collect on your unpaid invoices. And this is if you have a business now, or you work for somebody else, or you don't work for anyone at all. Get refunds on unused purchases. A lot of times we have stuff that we bought that we need to return. I mean, that is just cash money. Go and return your stuff. If you have a job, turn in expense reports, because that is all cash. That is all money on the table. And again, it's not sexy, but it's a way I try to make my folks think about, let's train your brain to find money, and money can be anywhere. So the first C is to clean up. The second C is to connect. And I say, if you already have a business, connect with a client that you haven't talked to in a while and see if they need something else or they want to buy again. So connect with your current client base, because they already know you. They already know that what you offer as a product or service is of value. You don't have to try to convince them, and make an offer and see if they will take something. And that's a really easy way to generate more cash. The third C is to charge more. And by that, I mean, raise your prices. I had a client that we fought for 3 months about raising her prices, and she thought everybody would be so mad at her. And I said, you know what, just charge $12 more per client. And I said, put it on the invoice. Tell everybody you're going to do it. Put it on the invoice. We called it an administrative fee. No one complained. Everybody paid, and paid on time. And it was enough money that she could hire a part-time assistant. So charge more. And if you don't feel good about that, what I tell my folks to do is I say, you know what, before you raise your prices, tell your existing clients that you're going to have a sale at the old price. So get in now before you raise your prices. And that actually generates a lot of sales. The fourth C is to convert. So take something that you have and bundle it together or mix it with something else to convert it into a new offering. So I have a client who's a musician, and back in the day when they sold CDs, she had like 4 CDs. So what she did is she took the 4 CDs she had and she bundled it and she called it the best of, and she sold it at a higher price range and people bought it. So it's a way to take what you have that's existing and convert it into something that seems like new and sell it in a different way. And then finally, my last C is complement. So work on your referral system. See what businesses complement the services that you do. See if they can refer you business and you'll refer them business, or join forces with that other company and offer a bundled product or service and make an offer together. So those are really easy ways to generate money for your business without actually having to do anything fancy. And it does work. Like that one lady who did the cleanup, that was $75,000 right there if she would just send out her invoices. So the other way I look at it, and this is more for my business owners who do a social impact business, is that even if you're a for-profit, you can actually take a donation. You just may not be able to give a tax deduction. So you could also, run a crowdfunding campaign where you ask for donations and see if anybody contributes. Sometimes people do because what you're doing is just good for the world and they will contribute. I can tell you when I converted over to being a social impact business, I actually had people who came and they said, you know what, I love what you're doing. I'm not going to give you cash, but I'll give you an in-kind donation. And they would donate supplies for me to do something so I didn't have to charge a fee for it. Or if I wanted a live meeting space, they would donate the meeting space for me, all sorts of things. Donated beverages like coffee and tea. So the other way you might look for money is looking at grants. And so in the interest of time, I'm not going to take you to the web to show you, oh, well, we can. Oh, well, no, we can't. We're past time. Is grants. So this is off of grants.gov. If you look down at the bottom, it says here, it says here, for-profit organizations can apply for grants. Small businesses can apply for grants. Individuals can apply for grants. So don't think that grants are only for nonprofits. And then I'm going to throw out one more thing, and then we're going to conclude here is, and this is part of my 25 ways to start up your business without investors. Texas has this thing called the Texas Event Trust Fund. And so if you partner up with a municipality or nonprofit, Texas matches costs related to conducting an event. And you see this a lot with sporting events. But what a lot of people don't know is it does not need to be sports related. In 2016, we in Texas hosted the International Juggler Association Festival, and the state of Texas awarded them $45,000. So if these jokers can get $45,000 from the state of Texas, so can we. So that's what I have. Let me go all the way to the end and just give you the last slide, because I do want to hit it home that we're doing two special sessions in one day, May 22nd, selecting your best legal structure. So we'll talk about like which structure works for you. And then if you don't want to wait, you want your LLC, we're going to actually do a second session where we will start on our LLC in session. If you have ever looked online, places like LegalZoom, basically we're going to do the LegalZoom $379 package at no cost to you. And the benefit is I'm going to be there to answer any questions you have about setting up your business. I think it's going to be really great. So you can walk away with having your own LLC just completely ready to file. I think it's going to be really cool. So if you're not already subscribing to Paris SBDC, I would get on that list now, because you don't want to miss this, because I think it's going to be really great. And it's on a Saturday, so you don't even have to take